This is Dentist Money. Now, here's your host, Reese Harper.
Welcome to the Dentist Money Show, where we help dentists make smart financial decisions. I'm your host, Reese Harper, excited for a new episode with my trusty old co-host, Sir Ryan Isaac.
Good afternoon.
Sir, it's a great day to be with you on this tax preparation Wednesday.
That's what we call every Wednesday in the office. No,
I'm excited to release this episode because we get a lot of calls year end around taxes, and we've decided we're going to try to do an episode a month around benchmarking. And this happened because, the reason we decided we do a show every week, as our listeners know, and we've decided to try to take one episode each month and focus it on the benchmarking that we're doing that month.
Yeah.
So that our listeners can understand a little bit how their situation might compare to hundreds of other dentists that we're tracking, and maybe how other people's feedback might affect the way they're thinking, because we get a lot of questions and we have a lot of we have a lot of concerns that come up during these months around these subjects, and taxes is the month we cover in December. Taxes is the thing we cover in December.
Yeah. Well, and the big question being, everyone wants to know, do I pay too much in taxes? How do I compare to the guy who makes the same amount of money as I do?
Yeah.
That's what everyone wants to know. And that's where this kind of began.
Yeah. And so we were upstairs, and the thing that we've been trying to figure out is, we have a big sample, but it's impossible to get people with identical incomes, right? Everyone's income's like within there's dollars different. Two people with $1 million of collections have very different incomes at the end of the day. And even if it's really hard to get like 100 people with exactly, $592,432 of income to compare it identically.
Well, spread it out even $50,000, and it could bump you into another bracket or cut off some deduction or some exemption, and then.
Yeah. So I guess big picture, we found that it's been harder and harder over time to compare effective tax rates, or the actual percentage of your income that you pay in taxes, to other people, because everyone's situation is so different.
Yeah.
That we found some different ways that we feel like are more effective to compare taxes that we think will be insightful today. But let's talk about the first problem that you've had, Ryan, in this month as you've been working on tax rate, which is how to calculate income accurately across all of the clients.
Yeah. The only thing I was going to say real quick is that the question that comes up is, we look at, let's take two people with $400,000 of income, and one person was paying 10% less tax overall than the other person. And so, and then we noticed that it was kind of a trend among any income group. And the bigger the spread to an income, the bigger the disparity in those tax rates. So, like you said, the first thing that we'll talk about is, how do we actually calculate income? What is income? And one of the things that we need to distinguish too for everybody listening is, how is this method of calculating income going to be different than what you might see on your actual personal tax return? Because we'll get those questions too. We're trying to arrive at a number that represents the actual cash flow that a client gets their hands on every year, right?
Yeah.
The gross amount of dollars that they can use for taxes and debt and spending and savings and all that kind of stuff. That'll be a different gross income number than the one that gets calculated for personal tax returns. We'll talk about the difference though, but we'll start with that. How do we calculate income? So,
let's start. Why do you want to calculate income the way you calculate it?
Yeah. So, like I was just saying, we want to know what is the total gross amount of dollars that someone even had available, because throughout the year we're trying to calculate things like what percentage of your money goes towards savings, or how much goes towards taxes or debt or personal spending. And so to be able to have the accurate picture, we have to know how much really came in the door. And the personal tax return doesn't always tell the whole story. That's why when we ask people, what do you think you make in a year? Most people underestimate it by a good margin.
Exactly. So if I'm going to add up someone's income, what are the things that I might take into a consideration besides the obvious stuff? Because the obvious stuff you'd think of is,
we start there.
I got to look at my salary.
Yeah, W-2.
And I have to have my profits that are on the bottom of my, that I take my business profits, and then like any distributions that I might pull out, which are also included in those profits typically on the tax return. But people think of it that way, like, well, it's whatever I took out plus whatever my salary is, and then there's some business profit. But that's about they don't really have, it's hard for an average dentist, and I can totally understand why. It's really hard to know what you actually make. Yeah. But that's what you think the total is.
Those are the two big ones. And what's interesting about that, though, is if you're an S Corp and you take your S Corp tax return and you take your personal return, if you have a retirement plan that reduces your salary at the business, the W-2 on the S Corp won't match the W-2 on the personal return. And if you take a 179 deduction, or you have losses that you're deducting on your personal return on Schedule E, then the net income at the bottom of the corporate won't match the net income on the bottom of the personal. So, I mean, it's hard.
Yeah, your business returns and your personal tax returns show different numbers.
And it's like, why?
So what's the real number? And for financial planners like us, our concern is if we don't know the true economic benefit that a client got from their dental practice, their true real cash flow income, then it's hard for us year after year to sort of measure whether they're making progress.
Or saving
using
enough
our
money.
elements, as you guys know, the second row of our elements table measures where your income goes. Do you spend it? Do you save it? How much do you pay in taxes, and how much goes towards debt? And if we don't have a good, accurate annual income number, it's hard for us to really make good forecasts and know what's going on, and if your overall situation is healthy as it should be.
So going back to your question, what are the categories we have? The two big ones: W-2 salary, net income.
What are some we don't think about?
Yeah, so a couple we don't think about. We add back in for gross income, like what money did you actually get your hands on kind of purposes. We add back in two categories that are actual deductions on the corporate return. One of them being amortization, which is when you slowly write off you deduct the goodwill of the business that you purchased. And then the other one is depreciation. Amortization shows up usually in statements towards the bottom third of the tax return, in a list where you'll see like supply costs and labs and things like that. Depreciation is, I think it's line 14 on an S Corp return. It's right in the middle on the front page. And that's the deduction you take slowly over time for buying stuff, doing a build out, buying equipment, things like that. Why do we add that back in, I guess, is the important question.
Yeah, we add those things back because those aren't real cash expenses that you incurred. They're government allowed write-offs that you get for things that have happened, things you've purchased. So like when you buy a practice, you're going to put a loan on a certain schedule and you're going to pay it off. You'll either pay cash or you're going to pay it off in 7 years or 10 years. But the amortization that you get is going to be written off over a much longer period of time. Longer than your payments on your loan. And it's not a real cash expense, and either is depreciation. If you buy a computer or if you buy, let's say you refinish your space and you put in a bunch of new TIs and 4 new chairs, some of that stuff will be 179 depreciation.
Which is where you just take the depreciation and do it in 1 year instead of spread it out.
Some will be spread out over 5 to 7 years and sometimes more. And so you have to add back depreciation in order to get a sense of what someone's real income was, because it's not a real cash expense.
Yeah. So those are a little less known, and then there's a few smaller ones that
they can add up. And it depends on the situation. One would be a dentist who owns the building they practice in and owns it in like a separate LLC, and then makes a rent payment from the corporate entity to the LLC that owns the practice. And sometimes people will overpay on that. And then they'll take the overpayment out of the LLC that owns the building as a net income distribution. Just it's more net income from another entity. Yeah, they pay money to the entity that holds their building, and then they just take the money out of there that they don't need.
Yeah, so if they make 50 grand of payments in a whole year, but they pay 100 grand to this entity, then we have to add some of that back in as income because it is taken in income just in a different spot. That's one.
Yeah, and it's hard to. That's a really tricky issue because a lot of people don't. People choose to pay different amounts of rent to themselves based on their tax planning.
Yeah.
So what we try to do is we try to normalize that a little bit, and we try to say how much of this is just to cover what rent would normally be in that situation. How much is it for building payments, and how much of it is really just excess rent that you're paying that should count towards income. Because a lot of people wipe out a large portion of their income by paying it over to an entity where they have their property, but that still needs to be accounted for in your personal income as cash flow that you you could have earned.
Yeah, and sometimes there's depreciation on those entities too with the building, and so you have to take that into consideration. Another one that's similar is there are some practices that where the owners also have their own management corporation. They might have multiple locations and then have like a central management corporation that maybe employs some people or has some services or pays for some things, and they'll pay a management fee out to that. But if there's net income from the management company as well, then you have to add that back in. So those are some of the smaller ones.
If you've never heard about that, don't worry about it because you don't need
we're not giving
one.
you advice on what to go do. We're just saying
you don't
some
necessarily
people
need one.
Yeah,
that's something
you're not missing out on something. Another smaller one would be there could be some, I was saying this before. The W-2 on your corporate return might be different than the W-2 income on your personal return. If you have like a 401k or a simple IRA, something that's reducing your pre-tax deductions off of your W-2 income, that'll be like reduced before it even hits your tax return.
Yeah.
So you have to take that into account.
So all the money you're putting into retirement accounts, that's technically money you could have just taken home. So it counts as income in our calculations.
Yep.
And then you could also add back any personal expenses. That I think is this last one. That's probably if you go to,
it varies a lot too.
You take a big trip and you justify it as a business expense. Is that really a business expense, or was that just money that you could have taken out personally and you just chose to write it off through the business to save a little bit on tax? What about things like some of your meals and entertainment, some of your travel,
vehicles,
some of your vehicle expenses? There's a lot of things that could be.
Those are smaller.
They're smaller, but we may choose to add them back in order to give people a better reflection of their income. So why do we do this? I mean, I think a lot of people are like, okay, it's a really complicated way to calculate income. And I think that we said it at the beginning. If we have two people that are both collecting $100,000, and one's tax return says 300 and one says 500, it's not always because they're actually making different amounts of personal cash flow. Their incomes might be similar. It's just one person might have a lot more tax deductions that year.
What gets reported
than another person. And we want to be able to say, well, we need to, it goes to the heart of why we do financial planning this way. We want to be able to say, does this person save enough money for what they make? Do they spend too much for what they make? Are they financing their debt the right way? And are they paying a fair amount of taxes? And especially as it relates to today's conversation around tax rate, it's important to really understand what someone's gross income is, their true gross income, before you can start to understand what their effective tax rate really is.
And how is this different? I mean, so then some of the questions we've gotten back are, how is this number different from what my accountant will calculate? And what an accountant's trying to do is kind of the opposite of what we're trying to do. Accountant wants to get the smallest number possible to get reported as your final adjusted gross income that you're going to pay tax on.
Which is great that they're trying to do that.
Yeah, that's really good. So, but that's why those numbers will be different sometimes. And usually the difference will be some of those less common things that we add back in: amortization, depreciation, retirement plan contributions. If you put those back in, then our number will match the accountant's number that gets on your personal tax return.
Yeah. So before we get into the meat of our discussion today, let's just hit really quickly how you calculate taxes that you pay.
Yeah.
And I just want to summarize that in like 1 minute.
Micro Machines guy.
Taxes are paid in a, think of like a chart that has different rates at different levels of income. And this is going to get turned upside down in the next 2 weeks. So
listen to this podcast before January 1st.
Yeah, but next January 1st, 2018.
Yeah.
This would probably be the first time that we'll see a big change in our tax code. And if you want to know, one of the things that's changed is there's still going to be 7 different tax rates. So right now there are 7 rates of tax. There's
brackets:
10, 15, 25, 28, 33, 35, and the last one's 39.6.
I like how that at the end they're like, let's not do a round number.
Yeah, like let's do a 0.6. I'm like, who came up with that?
Let's put a decimal
Just
in.
Just
go
to 40. I mean, or at least go to 30.
Go to 39.
39.99. That would be better.
Isn't that funny though?
Yeah, 39.99. I always think about that. Like,
why you IRS.
So you got 7 brackets. There's still going to be 7, but they're going to change the amount of income that goes into each bracket. So right now, the lowest rate is a 10% rate. That means between 0 and basically 20 grand, you pay 10%. And then the highest rate is at 39.6. So anything above 470,000, you're going to pay 39.6 on. This is just federal income tax, and that's different than your state income tax. So just keep in mind that call it every 50 grand to every 100 grand of your income, your taxable income, you pay a different rate at those. And the higher your income gets, the higher the rate you pay. It's not the rate you pay on all of your income. It's the rate you pay on that specific
called marginally.
And that marginal is a confusing word. I hate it.
Yeah. My marginal rates. I paid 40% taxes.
Just every incremental amount of income pays at a different rate. And so different states, we won't get into this too much today, but different states.
Let's go through all 50 states and just talk about their
What's the first one in the state song? Is it Alabama?
Let's start with Texas.
Oh, you guys. Okay, so think about your state. You probably have you could have a flat state like we do here in Utah. You could have zero state income tax and pay just a lot of property tax, or you could have a really high state income tax like
California, New York.
And it could be varied in tiers just like federal. And then you have your payroll tax and you have your AMT tax. AMT tax is an extra federal tax, and payroll taxes you pay on the salaries that you pay yourself.
And payroll tax you're paying for Social Security and Medicare.
Yes.
Social Security, the portion of Social Security ends when your payroll, your W-2 hits just under 130 grand.
Yeah.
And then the Medicare, you keep paying
Keeps
for
going.
Medicare. Smaller chunk.
Yeah, and I think it's important to note too, the AMT, it looks like AMT will no longer be part of the new tax.
Oh, I think it's going to.
They're going to change how it's calculated.
Go to Twitter right now. It'll have been changed, but
yeah. Right now, the point of next year's tax proposal is it was supposed to make it simpler, and from what I can tell, we still have 7 rates. They went down a teeny bit on like 2% on some
all
of them.
The deductions are still there.
All the deductions are still there.
It's the accountants that I've seen like on Twitter are actually really excited. So like, this is better for our business.
Yeah, it's like actually, it's actually going to be like, it's going to take a year or two before anyone even knows
what happened,
what really is going on, and tax strategies start to be developed, and then people are like, "Ooh, now we're going to do this," and I'm like, "Great." Last night I was watching.
Man, I had my tax postcard ready. I was going to do the whole thing on a postcard.
I was watching Steven Mnuchin last night, like give an overview of this. He's the Treasury Secretary, and he's like, well, now the beauty of this, if you've ever seen him speak, he's like deadpan, and he looks like a mannequin. Like Mnuchin sounds like mannequin to me, so I always think that when I see him. But he's like deadpan looking in the camera, and he's like, well, the beauty of this tax plan is that we get 92.4% of the country will finally be filing it on a postcard. I'm like,
it's not.
Do you realize that's like actually not a thing? Like it's such a marketing pitch. I'm just like, I mean,
so put your postcards away, is what you're saying.
Yeah, and
the tax forms out.
I'm all for like trying to fix the tax system and make it simpler.
Yeah.
At this juncture, I just cannot feel like it's any simpler than it was.
It doesn't seem so.
It doesn't.
Hey, but let's wait. Let's see.
What do you mean? We know what it's going to be. They just released it. It's so freaking complicated.
Surprise me.
Anyway, so the
point is, all these things that we just described are going to be slightly different, but they're all going to still be there and applicable.
Yes.
And when you calculate your taxes, you just add all that stuff up. On a miscellaneous note, sometimes we will show we'll calculate, we'll put on the reports property taxes as well. We like to show people how that, where they live, how it affects some of the taxes they end up paying.
Yeah. So in our case, I think what we're going to get to now is if you want to know, do you pay more or less than someone else?
Here's the meat of all of it, right?
You want to know if you pay more or less than somebody else. Well,
seems easy, like an easy question.
It seems you could just like say, well, I made this, you made this. How much did you pay? Yeah. How much did I pay?
Yeah.
Well, by living in the state of California and making a really high income compared to living in the state of Texas.
Yeah.
I mean, you're automatically adding.
Your condo in California cost $2 million, and that Texas ranch was $400,000.
Well, I'm just saying your state
and the state
just
taxes
your state
were
taxes
different.
alone, you're double
Housing.
digits.
Yeah,
so I'm
housing to see. Yeah, so totally.
It's just there's a lot of things that make each person's taxable tax due that they owe.
Yep.
Very different.
Very different.
And I think people don't realize, that one person paying 50%. Of their income might not be unheard of. Nearly that much, where someone else might be, at 35% and they're making a similar amount of money. And I just think before you blame it on your tax preparer or before you feel too frustrated, it's helpful to go through some of these things we're about to discuss and understand that even if your time feels like it's, even if right now you feel like you're in a situation where you're getting the short end of the stick, next year or the year after, you might go through some of these things we're about to discuss and find that your taxes are a lot lower than the person you were comparing yourself to before.
Yep.
And I think this will be helpful. So talk to me about a few things that are surprising to your clients, Ryan, around taxes that people pay and how they vary so much.
Yeah.
Person to person.
Well, let's just start with number one on the list was depending on the type of entity structure that somebody has could affect the way that they get to deduct certain things, or the way that if you just let some people have practices where the income just flows through on Schedule C on their personal tax return. Like they don't have a S corp or something that they're filing it through. They'll pay different amounts of self-employment tax versus the person who chooses to put their practice in an S corp and has a W-2 salary and net income. Again, this is not like you should or shouldn't do this. These are just examples of someone chose to have a different entity structure than one other person, and that right there can make a little bit of a difference.
Yeah, whether it's a C corp, an S corp, an LLC, or a Schedule C, and how much payroll you actually pay yourself is a huge factor.
You could have two guys with the same collections in an S corp, and one guy pushes twice as much money through payroll for whatever reason. Could be a good reason for it, maybe a retirement plan or something, but that'll affect the amount of payroll taxes. And I mean, it'll make these tiny little changes that after a while it can end up to 2, 3, 5, 7% difference in overall tax rate. So
yeah, I think what is important about this takeaway is that there are better and worse entity structures for your state and your own personal growth plans and level of complexity,
asset protection
and collections level.
Yeah.
And so if you're not having a regular conversation with your tax advisor on entity structure, we'd recommend that you have that conversation periodically, because years like this, I mean, this tax proposal that's coming out could change people's perception of C corporations in a substantial way, where before C corporations really were kind of like an overly complex, stodgy,
hadn't been used
for
a lot,
services businesses especially. They're kind of unheard of, where now you've got that particular entity is getting the most favorable tax treatment of any of the entity
especially
types.
If revenue and income's high.
And if you have a large business, a large service business, a multi-location practice, this could really change your strategy. And I think that's something that, I think it's like, oh, great. Okay, we're simplifying the tax code. We're going to create a conflict of interest now around entity structure by having the rates that people pay be different for a C Corp and an S Corp. Well, the difference between C Corps and S Corps is in the C Corp world, you have everyone from Apple Computer to Tom's vacuum cleaner store.
Shout out to Tom's. Great little vacuum shop.
Great shop.
Yep.
Doing the same thing. They have the same entity.
Yep. Yeah.
And they pay the same rates. And so when the IRS is trying to regulate, or when Congress is trying to create a tax incentive for large companies and make us more competitive globally, I mean, they're applying a tax rate to businesses that are completely different from one another. And that does create a massive amount of like complexity by doing that. I mean, you've just cut tax rates for C corporations, and they're not as competitive for flow-through entities like an S corp and LLC.
If you're a service corporation, especially.
And it's like, well, what one should I do? And then your CPA will be able to have a good conversation with you about this, but there's not always an easy answer. All I'm saying is that I don't know that this resulted in less complexity, which was the original intention. And it's just really, really hard to see government fight so hard to do something and then end up like half of the people feel like it's a victory, half feel like it's a failure, and the half that feel like it's a victory are claiming it's much simpler, and the other half's claiming it's less complex, or it's more complex and a mess. Yeah. I try not to get too frustrated by the lack of dysfunction in Washington, but it's interesting to just see how much complexity is going to come out of this tax legislation.
Well, I mean, just this point alone. I mean, that just took 5 minutes to say that everything we just said about a corporate entity structure making a difference on your tax return will be different in January 2018.
And it's still going to be important to analyze it more than ever.
Yeah. So
I just tried to look up Tom's vacuum shop.
Did you Google it?
It doesn't exist.
Oh, man. Well,
it's not a thing.
It's a free name.
All
We
right.
just named it.
Fine.
All right. Another one would be someone who chooses at the business level to put corporately paid benefits, healthcare, and retirement plans will do kind of just separate as
Just talking about healthcare?
Yeah, some healthcare, maybe some life insurance. Some people do stuff like that. Different HSA plans and.
Yeah, it has a big effect.
So the thing that I've noticed is I'll look at two returns, could be same collection, same size of office. One person will have corporate health care that they'll pay for, the other person won't. And depending on who can get it cheaper, like maybe someone who's less healthy and has to shop for it because the business doesn't offer it, pays more for the health care. But they get a bigger deduction off of the personal returns on the above the line deductions for self-employed health insurance costs. I mean, that decision, made a difference, of maybe 1% or 0.5% in tax rate difference between the two that made exactly the same income but had different tax rates because of that healthcare decision.
Yeah.
So
Totally.
another little one.
Retirement plan you mentioned.
Huge.
And contributions there. I mean, there's literally people with the same incomes that could have. I mean, you have two people with $500,000 incomes. One person's doing a 401k of $16,000 to $18,000 a year.
Yeah.
And the other person's doing a profit sharing plan and defined benefit plan and 401k, all three, and deducting north of $200,000 a year.
Yeah.
And they're the same income level.
Yep.
And that has a massive effect on your tax.
Or two people have 401ks and one forgot to fund it fully and the other one did.
Two people have 401ks, same income. Someone just like screwed up payroll and didn't put enough in.
Yeah. It's super common. And I'm finding with clients that just a 401k is on average, it's reducing someone's tax rate by like 2.5% to 3%. Just 401k.
Just to have it
to have it there and fully funded.
Yeah.
So, I mean,
depending on your income level.
Yes.
And the lower your income is, the more substantial of an effect that'll have. Probably even be larger than that. Talk about the debt payments, how like debt and interest affects it.
Another one, how big of a business someone chooses to build and how fast they choose to build it will determine in large part how much financing they go get, right? And the more loans, the more interest expense someone has, the lower their income because they have higher write-offs. So, I mean, it's another one where it's a very personal. It's not just apples to apples income, Or my buddy has the same collections as me, but he pays way less taxes. Well, he has a ton of financing to finance his growth, and he writes off a lot of money, and you don't have the same net incomes.
But what you're saying is interest on loans has a huge effect.
Yeah.
On mortgages as well.
Yeah. So we'll get to that. That's actually we'll get in
itemized.
An itemized. The first, so when you go to your personal return, there's a few sections where you're taking money off of your adjusted gross income. Before adjusted gross income gets calculated, it's the front page of your personal tax return. It's like this little section at the bottom. They call those above the line deductions. Above the line meaning above the adjusted gross income line that's on the next page. Some of these are individually paid healthcare, HSA contributions, which is another one. I mean, if someone just chooses, they say like, hey, I'm kind of worried, I think my family will go to the doctor a lot, I'm going to choose a low deductible health plan with no HSA. The other one says I want a high deductible, but I want an HSA, and then gets to write off the HSA. I mean, that could make a difference too, HSA is half of 401k funding.
Yeah.
I mean, it's meaningful.
Totally.
Student loan interest is above the line deduction. Personal IRA contributions, if you pay alimony, there's some other deductions on there that aren't as common that some dentists, accountants will take. We won't go into those, but
I think the things you just listed, though, sometimes these are things that just aren't taken advantage of. These above the line deductions. Sometimes your healthcare premiums are not reported properly. A lot of this has to do with, are you giving your tax preparer good data? And do you know what data you're giving him and how that affects your tax preparation?
Yeah.
And if you don't give them the information, I mean, how many times, and I'm not trying to throw any CPA into the bus, because probably if you're listening to this podcast, most of you are probably doing this properly. But if you are how many times did you see tax returns just prepared slightly differently based on we don't know why? Like, why does someone not have this line item when we know?
Yeah, is that a style thing?
Yeah, it's like they don't have any self-employed health insurance on their tax return.
Yeah, but they pay for it.
Or there's no IRA contributions here listed. Mm-hmm. Or there's no student loan interest listed on the tax return.
Right.
I mean, these are manual things that have to be given to your CPA and transferred over to the tax preparation software, and there's no way for them to get that information unless it comes from you.
Yeah.
And sometimes they'll ask for it, and maybe you'll think you gave it to them but didn't, or you did give it to them and it doesn't get put onto the return. And so I think that also, in addition to just bad data, there's did you really take the time to do all of these things, like the maxing your HSA contribution, fully maxing your retirement plan that year, gathering up all your documentation around loans and interest payments, making sure you have accurate amortization schedules so that you're not miscalculating how much interest you did write off. These are not like things that are easy to just assume they're getting done.
It's good organization and good record keeping. Yeah. The next section, I was just having a conversation about this morning, and this is a really common. This is where you get a lot of variability in tax rate. And this is your itemized deductions section. Yeah. What's interesting about this one, just kind of on the outset, there's a provision. It's called the PEAS phase out. It's named after a congressman that wrote this. That says after a certain income limit, your itemized deductions, which we'll talk about what they start getting reduced after a certain level of income. They're talking about getting rid of the PEAS phase out. Yeah. So now we won't phase out your itemized deductions. But here's where, like you were saying earlier, the personal choice of what kind of house to buy in what area of the city you live in, what city you choose to live in, what state you're in, things like they make a big difference. The person who chooses a bigger house in a more expensive part of the city, a more expensive zip code, maybe higher taxes, maybe you just happen to live in a higher tax state, you will have bigger write-offs on your tax return in this itemized section. Yeah. You'll have less cash flow. Yeah. So it's kind of like a give and a take, Yeah. Another one too in this itemized section is charitable contributions. And you'll see everything from 0 to 6 figures in charitable contributions in a given year. And that's massive. I mean, someone who gives $10,000 versus $100,000 in charitable that's a big chunk of taxes. So
it's massive,
you might have your neighbor who makes the same amount of money, but you gave 6 figures in charity and he gave $10,000, and thanks everyone for giving to charity. But on taxes, it's gonna make a difference. So you can't compare the two anymore. Yeah,
and on your mortgage interest, apparently it looks like they're going to cap the mortgage balance though that you're going to be able to write off. As of 3 days ago, the proposal said it was a $750,000 mortgage that was the cap on allowable mortgage interest write-off.
Okay.
And so we'll find out what happens to that. So most of you, like me, who live in a zip code, who you can't hardly get a house for less than that money.
Well, then, you and your wife and kids would all have to share the same room.
Yeah, that's actually fine. You can get a garage for that in San Jose. You can get a garage, and if you're in Northern California, if you're in Manhattan, you can get a small closet for that. All right. But you could live in it. Like, you could learn how to sleep standing. It's possible. They do it on NASA. Okay, Gordy?
Yeah.
It happens.
But you know what's funny about this, though, is that I'm willing to bet, though, when people are comparing tax rate with their friends, they're saying, he pays less than me. I don't know how much they say, how much did you give to charity? Yeah, are they going there?
Not going there.
Probably not. But it makes a big difference. So that's the itemized deductions.
But just some math, Ryan. If I don't give money to charity, don't I still have more?
Yeah. So okay. That's the thing, that there's a trade-off between. This is the argument why some people will say, well, to lower your taxes, just go buy stuff before the year's over. Yeah. Well, you'll have more money if you just don't buy stuff.
Yeah. It's not like you get all of the money back.
Yeah.
So I think it's important
to
kind
of
keep that
rate.
in mind.
Yep. Cash flow and tax rate are two different things.
Mm-hmm. Let's talk just really quick about exemptions, because I think that makes a big impact, and people don't realize
that. Well, another thing.
And this is something that's getting increased in the proposal. So now we're looking at it. It used to be about $1,000, and now they're going to $2,000 credits.
So have more kids,
which we'll hit in a minute. There's dependent credits that are going to be increasing for people at lower income levels.
Now, this one phases out at a lot lower level than itemized deductions do. Yeah. But the size of your family will make a big difference in the taxes you pay. And what's interesting too is some of these things we've talked about, like above the line deductions. Let's take two people with really similar incomes, similar family sizes. One person happens to max out an HSA and it puts them just under the limit where their dependent exemptions don't phase out. They get to claim their kids on their tax returns. And their neighbor, the same amount of income, just had a slightly higher adjusted gross income. It got phased out.
Yeah.
And then that's a big swing in tax rate,
Yeah. And it's important. I mean, you should know these thresholds. When am I going to lose out on credits? When am I going to lose out on exemptions? Because maybe there is something that year you can do
where to keep you under the threshold.
Buying that car makes sense this year because not only do I save the money on my tax rate, but I'm also picking up some credits and that I'm not going to be phased out
exemptions,
of. Yeah. Anyway, let's talk a little bit about, we've talked about all this differences in tax return preparation. Give us kind of a big takeaway on why do you, like how you kind of compare people's tax rates, Ryan, and say, I think this person's actually doing a good job and this person is probably needs some work or could get a little bit more organized and take advantage of things. How do you know just by looking at people how to make that determination?
Yeah. Well, one of the biggest things that we're responsible for that we spend time on about twice a year is we talk about this a lot, which is the retirement plan, just making sure that the retirement plan that's in place this year is the most efficient, most cost-effective plan that you can actually max out. You have the dollars to max it out that you can possibly have, and it could change next year. So step one, from our perspective, the retirement plans, I mean, it's a huge one. It can range from $10,000 between a couple spouses doing IRAs to multiple six figures in a pension plan.
Yeah.
So having the right one makes a huge difference, and that's one of the first places we'll start, just to make sure it's the most efficient plan that someone has in place.
Yeah. What about like we talked a little bit about this, but if I'm trying to look at someone and say who's done a good job with taking advantage of all of the things for their age and income level, like if I look at two 45-year-old productive dentists, both collecting the same, and they both have a similar amount of income, but one person has $250,000 worth of exemptions, credits, deductions, amortization, depreciation, and another person has $75,000. I mean, right away, as a financial advisor, I'm at least starting to ask the question.
Yeah, why is that?
Why is that? And
what
why
happened?
did one person have so much? So many expenses that reduced their taxes where another person didn't.
Yeah.
And at least in like kind of at first blush, this may not be the case every time, but if two people have the same income levels, but the volume of these things that I just listed is larger from one person to the next, then I have to look at the person who has more and say they seem to be working harder at this, or they seem to be paying more attention to it.
Could be.
They seem to be like addressing it at first glance. That might just mean that you have a ton of kids and that you've
really expensive house,
and really expensive house.
Yeah.
But in most cases, people with larger tax deductions are people who are at least paying attention to their taxes, and that it's not always the wealthiest person, because sometimes just paying the tax and keeping the difference results in a higher net worth. But it is a red flag to me when I see two people with the same incomes, and if you're the person at the bottom of the totem pole in terms of you have you've got 10% the deductions and credits and exemptions that anybody else has.
You're top of the income totem pole and then bottom of the available exemption write-off totem pole.
Yeah, it seems like
that's a weird totem pole.
It seems like that's been helpful for at least for me analyzing client by client to just say this person doesn't seem to be taking advantage. If you're just going to run a quick benchmark and a number, it's easier to see that.
Yeah, and well, this month was a really busy month. This is the thing I would say to people who don't work with us or don't have an advisor that's communicating this frequently, whether it's a financial advisor or a tax advisor, is I found it to be, just based on the feedback we got, this was definitely one of the highest points of interest for our clients out of almost anything else in the whole year. People really want to know, like, we report, here was your income, here was your taxes. And they want to know, like, is that good or bad? And so we spent.
I think everyone wants to know, like, how do I make this go lower?
Yeah, like
that's basically what we want to know.
Is this okay? Go lower.
I want it to go down more.
But it was very helpful, though, even if it felt high and a little painful for someone, to explain, look, here's what makes a difference between you and your peer with similar income that pays less taxes than you. He's got more kids and he pays twice as much on his house and he gave more to charity, you know? Or he did use an HSA, you know, or he did claim this thing on something that you didn't claim that you could have, you know, and let's take a look at that. Or
his retirement plan contributions were twice as big. So, you know, that's why we're recommending that you should look at adjusting your retirement plan.
It makes a difference. And so some of this is just, it's good to know. Like, it's good to just, you know, we spent a lot of extra time this month explaining to people, you know, the 10 categories that can make a 10% swing in a tax rate between two different people with similar incomes. And that was really like insightful and helpful to people.
Isn't this one of those things too, where it's helpful to look across multiple years to look how your tax rate's moving? Yeah.
So another point, that's a perfect question. So another point to how to compare this is sometimes it's just good to compare to yourself. Look at trends of collections, of income, of profitability, and total taxes paid and percentage of taxes paid, and see how they're kind of trending together, you know?
Yeah. I think let's just go a bullet point summary of what you can do to make sure that you're actually lowering your tax rate as much as possible.
Yeah.
One, you've already said, make sure you know make sure you have a good understanding, I think, of a knowledge around all of these issues. Don't kind of go blind into it and just feel emotionally upset that you feel like you're being taken advantage of.
Because your peer said, I paid way less than that.
Yeah.
You didn't? What's wrong?
Yeah. Or if someone says, my CPA is super aggressive and I'm not paying hardly any taxes, take that with a grain of salt, because you need to be able to actually compare apples to apples and understand whether that's...
It could be true if you just like revamped a whole office and took it all in 179 deductions.
Yeah. I mean, and then there's just you know, good tax planning, and then there's illegal. and they're different. All right.
Yeah.
So let's talk about legal. And I think there are people that run more through their practices than others in a proactive way.
Yeah.
I mean, there are people who will just say, understand the legal limitations of deductions, and they try to maximize as much of those as possible.
So wouldn't you say that is a product of frequent communication with the person in charge of your taxes?
Yeah.
To like have discussions about that. Like, hey, I spent money on this with my staff. Or I did this with another practice, another office for marketing. How does this get applied? And what are our options for doing
Can I call this a business expense? Can this be a business expense?
Yeah. You know, is this marketing or meals and entertainment?
Yeah. And trying to just understand that each deduction has certain limitations, but man, there's a lot of gray area with taxes, and a lot of people interpret the tax code very differently. Mm-hmm. And so you just need to have a comfort level with your understanding between you and your CPA that you're actually coming down on the side of a piece of legislation that you can defend and feel good about. But having no communication means that it's never going to happen.
I mean, if you just wait till the end of the year, then you'll just get a number and pay it and be mad.
Yeah. Spreading out like depreciation and 179 expenses in a way that's optimal for your situation is really important. And then thinking about the timing of new purchases and how to pay for those. Also thinking about retirement plan contributions that, like you mentioned. I think a lot of this just boils down to if you've got if you're maxing your retirement plan contributions, and if you're taking advantage of all the legal deductions possible, if you're putting money away in all the above the line areas you can, and itemizing as much as possible that you would normally itemize anyway, you're going to have a lower effective tax rate than the person who kind of just says, it just is what it is.
Yeah. And
that we see that a lot. There are people that just kind of just let their CPA prepare their tax return and don't get that engaged. And then there's people that really get involved, and those effective tax rates are meaningfully lower.
Well, and so I mean, think about it. If you can save 1 to 2% a year, 1% a year of your whole tax bill for the next 25 years, and that's a meaningful chunk of money that will matter. It'll matter in retirement. Yeah. All right. Well, thanks to everyone for listening, for joining us today. We really appreciate it. This will all be pretty different, a discussion in about 2 weeks.
Yeah. Forget everything you just heard.
Hurry and listen to the episode.
All this will be relevant in 2 weeks, but it's crazy the changes in percentages.
Yeah.
And some of the specifics are going to be very different.
It'll be interesting to see how it all plays out a year from now.
Maybe everyone's going to come back with a C Corp.
Yeah, I don't know. Maybe that was not advice, but anyway. Check out the Dennis Money Show on YouTube now in full Technicolor and remastered in 3.1 Dolby. digital.
Yeah.
Is that what they say? Yeah, they got the little thing.
Thank you.
YouTube, Dennis Money Show. If you'd like to talk to us, if you have questions, if you want to know how your tax rate compares to someone else's tax rate, if you want to know what you might be able to do better to save more money, go to dentistadvisors.com. At the top of the webpage, there's a little link for our calendar. Just schedule a time at your convenience, and we'd love to talk to you. Or you can just call us at 833-DDS-PLAN. Love to hear from you.
Carry on.